There will be blood in the markets, warned JP Morgan the day after Trump's tariffs were announced. And for a hot minute, it looked like they were right. Markets panicked, forecasts tanked. There was pulling of hair and gnashing of teeth, and a recession felt like it was coming any second. But now there's a plot twist. You see, Donald Trump's walked all that tariff talk back, or well, let's say he softened quite a bit of it. Tariffs down to 10% on everybody except for China. China, of course, will be hit super effing hard. Everybody else gets a 90-day delay with 10% in between with time to negotiate deals, and everybody wants to make a deal. The Canadians, the Indians, the Brits, everybody. Just like that, the bull market, we're so effing back, baby. So what do we make of this mess? Are the economic alarm bells still a concern? Was this JP Morgan report accurate? And what does this all mean for your magic internet coins? Well, let's break it all down. JP Morgan, of course, doing a complete 180 on its economic forecast, and it's not a very pretty report. Before Trump's tariff walkback, they had increased their odds of a recession in 2025 up to 60% from 40% just a month ago. Its forecast for the full year GDP growth is down from 1.3% to minus 0.3%. JP Morgan aren't the only ones downgrading their forecast. Barclays also sees a contraction. Citibank also coming out saying growth of just 0.1%, which is basically stagflation, while UBS has lowered its estimate to less than 1%. Unemployment is expected to rise from 4.2 to 5.3%. Core PCE inflation forecasts have been bumped up to 4.4%. That's a full 1.4% higher than they predicted just a few months ago. And yes, tariffs were the panic trigger. But tariffs aren't completely finished. And even 10% tariffs is going to have an economic impact. And China being the world's second biggest economy, there's still a lot of room for chaos, which I want to talk about this report. The initial announcement had markets bracing for extreme impact, basically a crash landing, higher consumer prices, squeezed business margins, reduced export volumes thanks to retaliation from China, which partially that is still very much a part of the picture, and we are not out of the woods yet. I would just like to underline that. Now, if the two top economies in the world can't work this one out, it's the classic economic squeeze. Your dollar is not going to stretch as far because a lot of things come from China, okay? And they're trying to stop the loopholes by making sure that Vietnam, for example, is not exporting Chinese goods around these tariffs. People will start losing jobs in this situation. Global trade machine is going to slow down very fast. But here's the curveball. Since that JP Morgan report dropped, Trump has thrown the market a bone, dialing back a lot of those tariffs, okay? Again, except for China, still facing higher rates. Now, that move was enough to flip investor sentiment back to mega bullish, basically instantaneously. So, crisis averted, and why am I even making this video? Well, see, the thing is not quite. Not quite. Businesses already started bracing for higher costs. We don't know if this is a genuine reversal or just another strategic breather before the next gut punch. Really, we still have huge headline risk, okay? And companies are afraid, and they may not hire as many people. They might fire people. They might cut back, all this kind of stuff. Even 10% tariffs still hurt margins and still raise prices for companies that have very thin margins. And with China still in the firing line with gargantuan tariffs, retaliation risks are still very much alive. If a deal isn't done, JP Morgan thinks that the aftermath could ripple through the economy very quickly. They expect the real pain to show up in Q3 or Q4 of this year, bracing for a two-quarter recession starting in June, with GDP shrinking 1% in Q3 and 0.5% in Q4. While Trump may have done enough with the tariff walkback to delay an imminent recession, that does not mean the United States is in the clear right now. Okay, let's just be straight about that. Let's not forget that a recession is not actually the most hated word in economics. There's a different word. We're going to talk about that momentarily. Before we get to that, guys, if you're trading these cryptocurrency markets, I know a lot of you are, you want to long the rips, short the dips, buy some exotic altcoins, well, check out BitUnix, one of the hottest exchanges in the cryptocurrency market right now. Deep liquidity across all the major pairs. And guess what? It doesn't matter where you live. You can use BitUnix. Okay, it's available to everyone, everywhere, no KYC, no VPN. Check it out down below. You'll get some exclusive bonuses too when using that link. $10 for free on sign up, 20% deposit bonus. So you put $1,000 in, they're gonna be $200 back in a deposit bonus. It's pretty damn cool, and $500 in trading bonuses. So if you are a cryptocurrency trader, link down below, go check it out. So, what is worse than a recession? A depression. Well, we're not talking about depression. I don't think anybody's honestly talking about depression except the doomers, but people are seriously talking about the chance for stagflation. JP Morgan's chief economist didn't shy away. He basically said it out loud. The United States is walking straight into that stagflation zone, the lethal combination of higher than normal inflation. And even if we get lower inflation prints this month and next month at the CPI, well, guess what? The tariffs could push inflation higher later this year. Rising unemployment as businesses pull back. Okay, lower negative growth. Apparently coming soon. With all the stagflationary ingredients there, the USA could be facing a nightmare scenario unless, again, we really do reverse course dramatically. Because normally when growth slows, inflation also cools off, but not here. Instead, inflation staying relatively high, even if it's a bit cooler this week. All the pain that comes with a recession, but worse, due to the higher inflation problems, will be the typical stagflation scenario. And here's the critical problem. The Federal Reserve has no real good options left on the table in this situation. If they keep interest rates high to fight inflation, they risk crushing the labor market, tipping the U.S. into a deeper recession. If they cut rates, they risk pouring gasoline on the inflation fire. Now, the good news, eggs are down, orange juice is down, gas is down. A lot of things are down recently, okay? That needs to stay like that because it's real catch-22 for the Fed if it doesn't. And the Fed knows it. That's why, according to JP Morgan, rate cuts are coming starting in June, likely continuing through every meeting into early 2026. We could even see the federal fund rate drop all the way to the range of 2.75 to 3%, which is really good for the economy, by the way, as long as that's not done during the middle of a horrific recession, which it could be the case, so that's not good. Anyway, big drop, though, from the current 4.25 to 4.5 range that we're in right now. These cuts are so desperately needed to give the housing market a break, to let businesses borrow money to expand, given the almost $10 trillion in national debt that's due to be refinanced shortly as well. That's going to hit the U.S. taxpayer hard. Now, maybe things have changed now. The rate cuts are less urgent, but if the Fed starts cutting into a stagflationary backdrop, markets aren't going to see that as bullish. Markets will panic once again. Emotions are very raw right now. The market is very untrusting at the moment. And if we zoom into what's happening at the ground level, that's you, me, and really every household out there, JP Morgan's view is clear. Consumer sentiment is in the toilet and people are scared. And that doesn't change with one quick headline, although it definitely helps, that one headline. But we still have a lot of things to work out. We have a lot of deals to cut. We got to see what happens with China. Inflation has to stay down. Tariffs have to not push inflation up. Consumer spending, of course, which props up the U.S. economy, has been slowing. That needs to go back up. People need to be less afraid to spend. Inflation is biting hard. Real incomes are eroding as wages aren't keeping up. They need to actually reshore those high-paying jobs. People aren't dipping into savings anymore, not when uncertainty and fear is this high. This combination could mean demand-heavy sectors like retail, travel, and hospitality are more likely to take a hit, which creates a negative feedback loop. If those restaurants aren't getting as many people, they can't hire as many staff, they don't have, the owners don't have enough money to spend on vacations, all that stuff. On top of that, exports are projected to decline. So even if these tariffs remain at these new lower levels, the fear itself has ripple effects, and the outcome of even the lower tariffs is still yet to be seen. Businesses will pull back in this situation. Households go into savings mode. We've seen savings have increased dramatically over the past few weeks. And when domestic demand and exports drop, the economy gets squeezed from both ends. This is where things are interesting, though, for us in crypto. You see whether or not this doom and gloom scenario plays out in 2025, it will eventually at some point, because the next financial crisis is always just around the corner, isn't it? It's funny. Bull markets climb the wall of worry. Bear markets descend the stairs of worry. Then the end result's always the same. In a world of weakening currencies and increasing global instability, Bitcoin doesn't just survive, it shines, okay? Don't bet against Bitcoin. The more fiat currencies are debased, and they will continue to simply be debased over time, the more attractive hard assets become. JP Morgan's forecast of a lower Fed fund rate and sticky inflation that, even if in the short term is going down, could spike later due to any kind of tariff situation, could be the nice dream setup here for Bitcoin in the long run. We could also see a renewed wave of institutional allocation into crypto as hedge funds, sovereign wealth funds, et cetera, look to diversify out of bonds and into, well, an asset that year over year basically beats everything else. And let's not forget, the last time the Federal Reserve slashed rates aggressively, they printed a ton of money. Now, that was because a crisis was going on, but stagflation could be a crisis, or could lead to an even bigger crisis, a bigger recession. Bitcoin went from 3K to 60K in that situation when they started printing the money. By the way, with Bitcoin holding up so strong during the tariff trade war, it's showing, of course, that the global economy is still shifting, but that people, during that shifting economic uncertainty, held their Bitcoin or bought more. The traditional playbook, to some extent, is being rewritten. And in every crisis, there is an opportunity. And if you're stacking sats and staying ready, thinking long term, you'll be just fine. Thanks for watching.